Raj, good to have you here. Is this near-term sort of correction we are seeing likely to continue?
Well, it's quite possible that is the case. I think what has happened is that, the one thing that we can say for sure is with, there was a PE expansion of the market that was taking place with the global cost of capital, coming down. I think at least that phase is over, which is as interest rates are going up, the valuation re-rating of the equity as an asset class, that is over. And now the markets will have to look for earnings growth to kind of expand, as we move forward. Also, given the kind of fiscal and monetary stimulus that the developed market, particularly the US, has unleashed, there is a shorter-term consensus that the 10-year Treasury yield in the US is going to 2%. If that is the case, then of course it triggers a certain amount of technical selling because the dollar kind of strengthens and there is an FI outflow that kind of takes place. And so therefore, it does lead to some kind of a shorter-term technical challenge. The other challenge for us, well, there are two cross currents, right, because of this monetary and fiscal stimulus. The global growth is expected to, kind of bounce very, very sharply over the next 2 years, which may be favorable, but it comes at the cost of rising yields and rising commodity prices. And the latter, the rising commodity prices, are not necessarily great for earnings growth trajectory, at least for India. And therefore, there could be some derating or compression in expectation of earnings growth for certain companies in India. And that also leads to some kind of fundamental reassessment of those companies in the shorter term. So yes, in the shorter term, there could be a bit of a challenge for our markets.
Okay. So Rajesh, let me ask you this then. Is this a buying opportunity immediately, or do you think the shakeout could last a little longer? So perhaps it's wiser to stay on the sidelines for a while.
So it's difficult to, so look, in spite of all the challenges that I mentioned, we are hardly any percentage points away from the top, right? So markets really haven't corrected as much. So it's difficult to kind of assess the magnitude of, the decline at this stage, given that we're still in a very, very favorable medium-term kind of setup. The challenges are really, really shorter term, at this moment. So having said that, I think it makes more sense for you to go sectorally or company-wise. I think there will be a greater dispersion in terms of the returns or expectations as you move forward. So it's far better to focus on what the kind of stocks and sectors that you have, which let's say, as I alluded to, they're not getting impacted by the commodity rise, and which are favorable tailwinds. So it's better to have a more sectoral kind of bias at this moment.
And where do you where do you find opportunities, Rajesh?
Right.
And where do you see a downside?
So I think, certainly for us, I think IT is a fairly, a very large overweight in our portfolio. And I think that could kind of get favorable, they have favorable tailwinds. Let me just give you some context on IT. I think, when you listen to Rajesh Gopinath, he says this is the start of a multi-year tech spend cycle. If you listen to Nandan Nilekani, he says it's never been a better time to be a system integrator to offer solution with disparate technologies to customers at this moment. If you listen to Satya Nadella, he talks about if we are spending 5%, of GDP on tech, as you move forward 10 years later, we'll have to spend 10% of GDP, on tech. And companies which, move to digital transformation are the ones which are likely to succeed. If you listen to Jamie Dimon, again, he probably says the same thing. So you get the picture. Basically, there's a lot of tailwind structurally for the IT services sector. Apart from the fact that the work from home environment has meant a lot of structural cost savings for the IT services companies. So I think that is clearly a large overweight for us, which can do well regardless of the current environment that you are in. Having said that, on the negative side, let us say I think automobile companies could get impacted. They've already had the increase in prices due to the BS6 norms. Now they have a increase in cost because of raw material, which is steel, aluminium, copper, etc. Petrol is at 100 rupees. So I think those areas could be a little bit under challenge, and particularly the two-wheeler sector, according to us.
Okay. So, if we could dwell on that point a little more, you like IT, we get that. And the market of late had started going full on the economy trade,
Sure.
the longer term, recovery in the economy. First of all, are you a believer in that trade? If yes, then what sort of sectors would you play it through?
Yeah, so definitely, I think given that we are at the start of a earnings cycle and a credit cycle, I think the belief that which will be helped by the tailwind of global growth. I think global growth. I think it makes sense to have a positive perception about the capex cycle or the industrial cycle kind of moving on the positive side. Of course, there are challenges. I think there is a promise of privatization, etc., that has been that has yet to be delivered. So execution definitely is going to be a challenge. It's unfortunately, I don't think there are too many stocks in that area which we find attractive in terms of valuation for us. So there are other methods that we play, this cyclical trade, probably through cement or, let us say banking, etc. So that's really how we are playing those trades, because those are more comfortable to us, as we move forward.